All right, you guys think we should get started? 12:30? Anyone who's late is late?
Let's do it.
All right, cool. Well, thanks for everyone who hopped on time. I'm Nicole. I run platform here at NextView. Thanks for joining. So today we're just going to talk a little bit about, what the partners are seeing in the market. And I did get some of your questions yesterday, so we're going to try and address as many of those as we can. You guys do have the option to unmute yourself and ask a question, just to avoid kind of the stress of too many people talking at once. I just ask that you kind of raise your hand, and then I'll call on you and you can unmute yourself, so that we don't have like 25 people trying to talk at once. So Lee, Melody, if you guys want to give a brief introduction, feel free.
Sure. Melody, do you wanna do the intro?
Sure. So hi, I'm Melody, one of the partners here at NextView, based in New York, currently sitting in my Brooklyn apartment. We usually work in Soho. That's where our office is. And, I joined NextView about 2.5 years ago. Before this, most recently was head of product at Blue Apron, where I ran product design, analytics, and data science team there. Joined as the first product hire. We're a company about 18 months old, 20 people. I also give a super quick overview of NextView. We're a C-stage firm, invest nationally, usually lead or co-lead investments. And we think a lot about what we call the everyday economy. Essentially, there are many different personas of everyday users, whether you're a blue-collar worker, software engineer, or everyday consumer. And we think about aspects of your daily life that we can redesign through the leverage of technology and internet. My partner Lee, he can introduce himself, but the NextView team has a previous either operator or founder background, and we like to work with founder closely through a very hands-on model post-investment.
Hey everybody, I'm Lee Hower. I'm one of the partners here at NextView. Also, thanks for joining us today. We're going to try and cover a number of the questions that folks raised already in terms of what's going on in today's VC ecosystem, given the economic and health and work realities that we all live in right now, as well as company hiring, a whole bunch of different areas. So we'll try and touch on as many of those as we can in the time allotted. Also, it's 12:30 in Eastern time zone, and so our team's split between New York and Boston. So anybody who's in the Eastern time zone and wants to eat their lunch on the Zoom, please feel free and go ahead. And if you're in another place, another time, do what you got to do. This is informal, and we're all here in it together. My background, I was one of the co-founders of NextView, which we started almost a decade ago at this point. It was in 2010. And before that, I was an early employee at PayPal when we were about a 40-person startup through the IPO in 2002 and scaled to eBay. And then after that, I was one of the co-founders of LinkedIn. So I've lived, I joined PayPal. I accepted an offer from PayPal in December of '99 and started working in the early part of 2000. So I saw kind of the tail end of the Web 1.0 boom and then into the downturn of '01 and kind of the tech crash, dot-com crash. Saw the kind of '08, '09, Great Recession. And in fact, we started NextView in 2010, really in the early days of kind of the rebuilding phase, but when I was still pretty depressed. So, all of us at NextView can offer perspective on, what's happening today, but also bring in, perspectives from others. And I know other folks here who are joining us today have lived through ups and downs of different cycles too. So that's great. We'll make this, so we're going to try and touch on as many questions as we can. And rather than just talking at the group, Melody and I will try and do it kind of conversationally, almost like a fireside chat sort of a thing. Even though none of us are sitting in front of a fire right now, but, as Nicole said, we'll probably start by kind of touching on the list of questions that people had already submitted. And then as we get a little bit further on, if people have questions and want to kind of stick their hand up and ask stuff, we'll try to touch on as many as we can. So I'll kick us off here. A bunch of the questions that we got were around what I would call the 60,000 foot question of what is the VC funding environment like right now, March 26th, 2020. And there's different questions around that in terms of what's it like right now? What is it going to look like in the next quarter or two or three? How is it impacting, how active people are, or valuations, or a whole bunch of things. So some of the questions were more specific, but, a lot of more around that question. And so just to start in terms of what we're seeing, and then also, some of our thoughts of what might happen in the next few quarters. You know, we are seeing the VC ecosystem in literally just the last couple of weeks go through a period of introspection. And what I mean is, it is not that the VC ecosystem is closed for business or people are not doing new investments. In fact, at NextView, we've got literally right this second, we have 3 signed term sheets that are going to be closing in April, all 3 of them. And we're looking at new opportunities right now as well. So we're definitely not just open for business, but active and working on new projects. That being said, as many of you may know, a lot of VCs in recent weeks have basically been taking a lot of their time and energy and focus and talking to the founders that they work with to hear and understand what's going on in their specific businesses. And then B, they're doing kind of portfolio level reviews of what's going on across, all the different portfolio companies that we work with. Which companies are going to face significant impacts, in terms of headwinds to their business or other kinds of disruptions from, the coronavirus environment. What's the funding level of all these companies, right? Do companies have a short runway and need to raise money right away? Do they have a longer runway that they can not worry about raising money right now? Are they profitable, or can they get to profitable with the resources that they have? And there's a lot of hard decisions going on right now across the ecosystem, right? So, I talked with founders yesterday who their business is doing great, and we're super excited about what their business is going to look like a year from now, 5 years from now, 10 years from now. But they're also having to make some hard choices about, do we, let go some staff or reduce our burn so that we can extend our runway and make sure we can live and fight, into 2021, 2020, 2022 and beyond. And VCs similarly are right now, looking through their portfolio and assessing, okay, which are the companies that are in a strong position, which are the companies that are in a okay position, which are the companies that are in a more challenged position, and also assessing their conviction and what their reserves are of their capital base in terms of where are they going to be able to apply additional capital to support companies, where might they be, pulling back. So all of this is happening in real time for everybody in the VC ecosystem right now. And so it doesn't mean that, the funding environment for new rounds or follow-on rounds has necessarily, closed off. But it does mean that people are in a period of introspection, a period of kind of review and taking stock of what the situation is. Our best guesstimate would be that you do start to see some moderation of the size and velocity of VC rounds starting in Q2. It would be almost just only natural that in the backdrop of people spending a lot of time working with their portfolio companies, an environment where we as VC firms, just like all the startups that we work with, are now pretty much all virtual and remote. The process of getting to know a new team and getting to know a startup is just different now. And it doesn't mean that we won't invest in companies without meeting people face to face, but it does mean that we're adapting our processes and our investment decision making and evaluation in order to be able to make investments in a slightly different work environment that we have now. That we don't know whether it's going to be like this for a couple of weeks or a couple months or what. So I'll pause there. I don't know, Melody, you may have other things to add to this one.
Yeah. In terms of new financing rounds, so I'll start with how we advise our portfolio companies. I think there are probably 3 types of companies broadly defined. One is they didn't really plan to raise in 2020, and they continue to not plan to raise in 2020 and have runway way into 2021. Those are people that we don't really worry about, and I think that's the best position you can be in, to be honest. And then there's the classic company who wanted and planned to raise in 2020 this year, and in fact, maybe right now they're planning to go out, or potentially in the fall. And those companies were or are reconsidering whether they want to do that. I think that all things being equal, without considering either a tailwind or headwind given the COVID-19 situation, to the extent that you can avoid fundraising right at this very moment, we will advise our company to do so. And then a third class of company are just must raise and have to raise in the calendar year, in which case, we're obviously going to work with the company to come up with a plan and think about that. The other thing I would say in terms of existing portfolio companies, we are seeing, even for companies that are underlying businesses are still very strong and potentially even having tailwind given the environment, they're all going very aggressive in terms of conserving runway and being really conservative about burn and staffing. We've seen quite a few companies say, hey, business is great, but we're just going to pause hiring right now. And we're going to actually go back to the board and revise our 2020 plan to be much more conservative, because we don't really know how the funding environment is going to be like in 6 to 9 or 12 months. And honestly, we don't really know either. On talking to new firms about raising your new round of financing, like Lee said, we're open for business, and we are, we've committed to quite a few new investments over the past month or so. That being said, I think it's a learning process for us as well in terms of how to get to know the teams better when all you can do is through Zoom, and getting to the point of conviction. As an investor, everyone you talk to, he or she is trying to get to the point of conviction, and I think it's worth considering what are the things that you could do, which might not be what you usually do, to help the investor get there. And I think this is going to really help a little bit for founders who've, got to know the investor before this whole kind of pause situation happened. And like Lee said, VCs, especially over the past 2 weeks, have been spending a lot of time tending their portfolio companies. So maybe the bandwidth will open up because they got to prioritize, and ourselves included, got to prioritize going through the portfolio and making sure everybody has a plan. So the optimistic view is that maybe over the next month or two, everybody's bandwidth will come back a little bit, and then can steer the head towards thinking about new investments.
Yeah, it's a good point. We'll circle back to the, what might the 6 month, 9 month, 12 months, 2-year time horizon look like, and come back to that. But why don't we sort of stay on the thread of what can founders do right now? What is it like right now interacting with your existing investors or interacting with new investors? For founders who are pitching new investors, whether it's a seed round or it's a Series A or Series B, but they're starting new conversations with investors right now or in the near future. One thing I would say is, now more than ever, it probably you're going to be interacting with people on Zoom or telephone or some other kind of non-face-to-face medium. And if your investment process progresses with that firm, you're going to be interacting not just with 1 or 2 people at that firm, but then eventually the whole firm, likely in a broader pitch over video. And so now more than ever, if you're having a first meeting or second meeting with an investor, I would strongly encourage sharing a presentation deck or some other materials beforehand. Every founder has their own style in terms of, some folks prefer to have conversational meetings without a deck. Some firms, some founders prefer to do that. Some founders prefer to have a deck. Some founders prefer not to share it up front. They prefer to do it in the meeting. And again, I defer to every entrepreneur's personal style and how they like to present themselves and their business, to each their own. I think now more than ever, though, it is helpful to investors if you can share information before a meeting, so that when you're talking to them on Zoom, it's not them trying to focus on what's happening in the slide that you might be sharing or the demo that you're doing, but they can actually try to make some kind of human connection even via a video conference. And it just arms the investor to be more prepared and more informed about what you're doing and who you are, so that the interaction that you have, the synchronous real-time interaction that you have, can be a little bit more substantive than just reviewing a slide. Other things to think about, would be, not every founder is going to have this option, of course, but all things being equal, founders are probably going to have an easier time with investors that they have had some relationship with in the past. It's only human that it's easier and faster to build conviction about something if you have some prior context about the founder or the business. And so if you're going out to raise a round of funding now, it doesn't mean don't go pitch people you've never met before. But to the extent that you've, met people or interacted with people, or even if they're just familiar with your space or your business, even if you have never met them before, it's going to be easier and reduce the friction for them to evaluate your company than from a standing start. There's no magic tricks or silver bullets to getting to know people and presenting information over remote means like this. So we're all figuring it out. And I guess that's another thing too. I would say, don't forget that the investor on the other side of the Zoom is a human being too, and they're dealing with all the same things that you're dealing with in terms of their work style and their family style and their concerns about broader society and whatever else. So, now more than ever, being empathetic to the human side of everyone is probably a helpful thing.
I'll just add one thing. I think that usually, everybody here probably knows that it's helpful to get a warm referral from someone when you get in touch with an investor. I actually think that now it is probably going to help you a little more if you have a strong introduction, either through an advisor, that official or unofficial advisor who's a founder / entrepreneur / operator that has credibility, or your prior round investor. Because I just think that, to Lee's point of, especially as a seed investor who are looking at companies, a lot of times pre-launch, pre-product with very little data, any additional data point can become quite strong of a signal. So to the extent that you can, I would spend a little bit more time to figure out who can be a strong endorser of yours. And that might not necessarily come in the form of introduction, could be, unprompted, kind of dropping a line or two to the investor that you're talking to after you had a first meeting from someone you think has credibility with this particular investor. So I would encourage you to think about that to the extent that you can.
Hey, Melly, why don't we shift gears to hiring a little bit?
Yeah.
What can you, in the companies that you're working with, how have their hiring plans been impacted by the current environment in terms of, some are pausing hiring, some are slowing hiring, some are unfortunately having to do layoffs. And then even the groups that are hiring, we're all interviewing now in a different medium. So I'm curious, what are you hearing from the founders that you're talking to on the hiring front?
Yeah. So two companies came to mind. One, this company is, seed stage. We led a seed round in December, and they actually just launched a couple weeks ago. And they've been looking for a pretty senior head of marketing type hire. And obviously, with the situation now, this company is based in New York. So with the situation now, the meeting in person thing is out of the window. Now, my advice and other investors' advice to this founder has been, hey, keep using this time to build a pipeline and having these like virtual coffee chats, because when things come back to normal, hopefully, it could be 6 to 8 weeks, you immediately have a much more thorough and warmed up top of the funnel that you can go after. Now, the counter force that is going to be a challenge for seed stage company or very early stage company is that candidates probably are going to be slightly more risk averse. This company actually, they were looking separately for a different role, like more of a junior operations role. And they actually got someone who was ready to leave Walmart / Jet. And COVID-19 happened, and this candidate was like, well, maybe now I should stay with Walmart and make sure I have a health insurance and all those other benefits until situations settle a little bit. So I think that's something to keep in mind. But I would say that my advice for our portfolio companies that I work with is, look, you need to make this hire. And even though you can't really quite meet people for in-person conversations, it is still worth to reach out to folks to build up the top of the funnel and to at least have introductory calls and video chats to get to know the candidates.
Yeah, I mean, for the founders I've been talking to in the last 2 weeks, 2.5 weeks, I would say relatively few have basically said we're not going to hire anybody. So I would say most who are in a growth mode are still going to be in a growth mode, but that's probably a temporary growth mode, right? So for every 10 heads they plan to add in the next 2 to 3 quarters, they're probably going to hire 5 to 7 of those, not 10 of those. But most of them are still trying to figure out how to interview and move their talent pipeline forward, because even if they're conserving resources and maybe slowing down some of their growth plans on the hiring front, they still are oriented towards building their business 6 months from now, 9 months from now, 12 months from now, 2 years from now. So I would say a surprisingly few companies are in a complete halt around hiring, but I would say almost all are slowing the hiring that they had forecast to do. The companies that are in the unfortunate position of having to make some tough choices and lay off some people in this environment, it's never a good time, never a good choice to make, but the sort of it's necessary choices for some companies to be able to live and fight, and continue building what they're doing. The old adage of cut once, as deep as you need to go is true in the sense that it's really demoralizing if you're doing multiple rounds of cuts and what have you. So it's kind of like figure out what you need to do, make those tough decisions, execute in sort of one wave of layoffs, and move forward. I would say in general, there's always empathy for people who are being let go from an organization. I would say now more than ever, those companies that are, forced to let go a portion of their staff are being, particularly generous on severance and paying for health benefits, for a longer window of time, which is the right thing to do in this environment, obviously, given, everyone's going through this and facing economic and health uncertainties. So I'm cognizant of time because I know we had scheduled this for about 30 minutes-ish. I think, Nicole, correct me if I'm wrong, we can run a little bit longer if we need to. Is that correct?
That's correct.
Okay. So why don't we touch briefly on sort of what does the near to intermediate term future potentially look like, in terms of, are we going to see a long drop in funding? Are we going to see, a slow recovery, a sharp recovery? Are we going to see, a new normal? What's going to happen in the VC ecosystem amongst VC investors? I'll start with obviously the caveat of, if I had a crystal ball, I would have done, lots of things differently, of course. I would have gotten a haircut 3 weeks ago and stocked up on beer and what have you. So, none of us have a crystal ball and can predict the future with perfect certainty. But based on sort of having lived through other kinds of, recessions and contractions and crisis periods, which were different than this, like nothing is quite like this. And also just trying to make an assessment of the information that we have in front of us, in terms of both the public health and the economic and the financial ramifications. My best guesstimate is that you will absolutely see a slowdown of VC funding activity in the second quarter. It wouldn't surprise me if that continues in the third quarter, regardless of whether, we're starting to see some normalization or a new normal of, people coming, being less on an economic lockdown. I do believe you're more likely to see a more of a V-shaped recovery from this crisis than the financial crisis of 08 or 09, or of the dot-com telecom crash of sort of, 01 timeframe. And there's a whole bunch of reasons for that. And rather than spend 20 minutes on talking about how this is different, I'll just share my perspective that my base case assumption is that there will be a sharper, less gradual recovery than in the last two major economic crises of the last couple decades. I do think I don't think that 2021 and 2022 are going to look like 2018 and 2019. I think you're going to see in the future a moderation of, just less of an abundance of capital. We've been coming through a period of time for the last 4 or 5 years of massive bull markets in the public equity markets, which translated to, very bullish markets in the private VC markets. It translated to really big rounds. It translated to really high valuations. It translated into FOMO thinking by many people across the ecosystem. And I just don't think we're going to go back to that. I think for any of 10 different reasons, it will be a new normal. And I don't think that it's going to be completely dropped off a cliff, but even a modest contraction coming out of a period of great abundance feels like a contraction, right? So, I don't think we're going to see as many $100 million rounds, $500 million rounds, and very, very heady valuations. That being said, the underlying economy, once it can get back onto its feet, it's going to be painful and it's going to take time. There's lots of people who are going to be displaced, but we're coming from a place of relative economic strength in the recent past. And so I'm optimistic that at least the United States economy and hopefully the global economy can regain a lot of that momentum, maybe not all of it, but much of it in the next year or so. And the underlying innovation waves that were happening are only going to persist and get stronger. And so, all the things that were making, 2020 an interesting place to be investing in innovation and technology startups, I think will still be there in 2021, 2022. Last thought, I do think you will see a VC ecosystem, which is smaller in the coming 2 to 3, 4 years than it was in the most recent 2 to 3, 4 years. Whether you measure that in terms of the size of any particular fund, whether you measure that in the total number of VC funds out there, whether you measure that in the number of new entrants, sort of raising funds and entering the market, it's almost impossible to go through a macroeconomic and financial shock of the scale that we're going through right this second, and not have the VC ecosystem be smaller in the coming years. So I'll wrap with that. I don't know, Mel, if you want to touch on your crystal balling and what you think. And for folks who have a question beyond the ones that we've already touched on, maybe sort of get ready with Nicole to be able to chime in.
So I'll just add 2 things.
You can use the raise hand. You can use the raise hand feature in the participants in Zoom.
Yep. So I add 2 things related to the VC market. I don't have a better version of the crystal ball on a broader economy than what Lee just talked about. For seed and pre-seed, I think that there are 2 forces. That one is a pro case and one is a con case for funding. The pro case for seed and pre-seed is that seed funds, institutional seed funds, are usually designed to put the majority of dollar at the seed stage, as opposed to later stage funds that have significant reserve to follow through every single future round. And that is important because at this very environment, on the margin, people are going to start thinking about making sure that they have the reserves available for companies that otherwise might not need some kind of bridge situation in a very strong market, but they're fundamentally good companies. So, investors are going to think about dollar and asset allocation probably with a slight bias towards existing portfolio companies versus new investment, which just means that the dollar available for new investments will probably drop a little bit. But seed funds has less of that dynamic versus later stage funds. Now, on the flip side, in the past 5-10 years, there's been a wave of new seed entrants coming in. Not as much for firms who lead deals, but there are quite a few new entrants for smaller first-time funds or even second-time fund who are in probably the usually write a smaller check into the syndicate. I do think that that will, to a certain degree, decrease because they might face some pressure when it comes to raising additional capital, raising a new fund from LPs. And this is a wholly separate topic, but the very short of it is for a lot of LPs who are limited partners, who are investors in venture funds, they think about their asset allocation as a percentage of their total asset under management as, oh, X percent is allocated for privates, which include private equity and VCs and all, anything that's not a public market. When the public market contract by 30%, you have what you call a denominator effect, and they will be much more conservative when it comes to allocating to VC asset class. So that's something to keep in mind, and I think we'll see possibly a contraction in additional availability, especially at the seed stage, because these firms tend to be less established than the later stage firms. Now, for Series A and beyond, they do have this effect of potentially wanting to shift their near-term, even medium-term focus and capital available to preserve for existing portfolio companies. So they are probably going to be more cautious as well. They potentially face less pressure from existing LPs because, to the extent that they're more established, which by definition they are, because they, seed only as an institutional category started coming into existence about 10, 15 years ago. So that's something to keep in mind. But I think, regardless of the fundamental causes, I think Lee is right in the sense that 2020 and potentially even extend into early 2021, you're going to see a smaller pool of capital available for venture. Now, that being said, a good company is a good company. So, this is why people are excited about continuing to be able to make investment during times like this.
Everyone, this is Ishwan Godfrey. Can you guys hear me okay?
Yep. If you can speak up, just speak up a little bit, but I can hear you.
Sure. Sorry, I'm on my AirPods here. I'm founder of Apiary. We're the modern household manager. Think of us as when Google Assistant meets care.com. I'm actually really curious to hear your perspective on the future state of the everyday economy, how COVID will have an impact, or do you think this is just a blip, or do you think there's going to be some fundamental shifts in businesses as we incorporate what we are going through now into our business in the long term? Thank you.
Yeah, great question. Thanks. So this is actually something we've been talking about at NextView, not only because our job as seed investors is to be thinking about what the world is going to look like 5 to 10 years from now and invest into those trends, but also we have this specific focus on the digital redesign of the everyday economy. So I'll tell you what our real-time best thinking is, and ask me next week, which might be different than this week, right? But I think our base case assumption is that there are lots of aspects of life that are going to change around the margin for a long time, and there are a handful of aspects of life that might change materially as a result of this pandemic. The obvious ones are things like, in the near term, there's going to be impacts to businesses that have a high degree of face-to-face contact, whether you're in, if you're a business that touches the travel industry or the, retail industry or the hospitality industry, you're going to face headwinds. Unless the nature of what you do fundamentally changes that dynamic and makes it easier for people to interact with your service in a different kind of way. And I think the obvious ones are all the ones that I think probably many of us or all of us have thought about, which is, okay, we're running this big experiment where everybody works from, knowledge workers. There's a big swath of the workforce that doesn't work on Zoom and Slack and whatever, but the sort of knowledge worker part of the workforce that does, we're all running this big experiment of how much do we really actually need to be in the office to do what we do. And, it would be pretty surprising to think that there isn't at least some increase there was already a trend of greater remote and distributed teams and whatever else. That's only going to accelerate likely, both in terms of companies being open to working with people on a more remote distributed basis, or even people who are co-located in an office, for there to be greater flexibility for, telework, remote work, however you want to think about that. I think if you start thinking more broadly though, there's some other interesting dynamics that may come into play. The things that are like around the margin are people still going to get on airplanes and go, on a vacation or go travel for business? Absolutely. We're still going to go do that. Are people for the next 5 years, 10 years going to marginally decrease the amount of travel, long distance travel that they do, given the kind of what we've just been experiencing right now? That's probably a reasonable assumption. In the same way that, people who are entering the workforce in 2009 have very different views about employment, and they have very different views about trust of legacy financial institutions, and all of those things. With that, now with the benefit of hindsight, we saw consumer sentiment and behavior change. There's going to be those kinds of consumer changes too. It's conceivable that we've been in this. We were talking about this the other day, or this is my theory. We've been in a period of multi-decade long period where there's greater and greater urbanization for both personal and professional preferences, and more people are flocking to big urban centers in the United States and in other parts of the world. It is conceivable that some people may not want to live in New York City and may want to live in a less dense part of the country 5 years from now or 10 years from now. So I don't know if we certainly don't have a crystal ball, and we're literally like in real time trying to think through what are the implications over the next 5, 10 years plus to consumers' everyday behavior that will change this. I don't know if Melanie, if you have other ones that you want to touch on.
Yeah, what I'll say is the framework I have in my head, and this is evolving real time, is a large swath of the population has been forced into what, in my mind, kind of like a forced experiment. A lot of times, an accelerated schedule that otherwise would have never happened, or at a scale that would have never happened. And I think what you want to think about as a founder, and what we want to think about as investors, that kind of behavioral change is currently forced down to everybody's throat. And we don't know, how long it will last, maybe 4 to 8 weeks, maybe 3 months. And then coming out of that, at the end of a tunnel, what percentage of those behaviors will be permanent, and what percentage of behavior will snap right back how things used to be? And I think that, then this goes in a little deeper. For example, right? E-learning, which is forced down to the throat to a lot of different households and parents and teachers and school systems and whatnot. And public school systems around the country had to scramble to figure out how to do that, how to train their teachers, how to get equipment and all that stuff to everybody, which they would have never done. And it would have never happened, especially for a school system like New York, which is so huge and diverse. And coming out of that, you're like, okay, what are the different actors in this ecosystem? And given that experience and the hurdle they have to kind of jump through, are they now in a better position to appreciate the pros of this experience versus the con or the investment that's required? And I think you can apply that lens through a bunch of different things, like, grocery shopping, probably another example, right? Now, a lot of people are more inclined to shop groceries at this very moment through players like Instacart. And to what extent would Americans miss going back to their grocery aisles physically once this whole thing is over? And I think everybody will come out of that with a slightly different conclusion, but I think that's an interesting framing to consider and think through activities and behaviors that would have a chance of sticking, as opposed to disappearing and snap right back to where things were 4 weeks ago.
So we had one question submitted on the chat from Scott about if you're a company that's raising new capital in 2020, how should you think about valuation? So let's touch on that one. And again, just time check, we'll probably run another 5 minutes, 10 minutes, and then we'll probably have to wrap up. But so we'll take this question. If there's maybe one more, we might be able to do that. So if you have to raise here in 2020, I think first off, it depends a little bit on your individual company situation, right? So if you're a company that's already raised 1 or 2 or 3 rounds of venture capital and you already have an existing investor base, there's a strong likelihood that you're going to be talking to your existing investor base as a potential source of your funding for 2020. That may not be the only. You may also have conversations with new groups for a new investor coming in. But those companies that have an existing VC investor base that's in a relatively strong position, and if the company's doing relatively well, there's a high probability that your existing syndicate might lead a new round of investment, or might at least be a meaningful part of a new round of investment that you do. For those companies that either haven't raised a great deal of capital previously, and so they're looking to raise their first round or second round of capital, or even those that may have raised capital previously, but their existing investors just don't have significant capacity to invest more money in the company. If you're going out and having new conversations this year, I would anticipate valuations being lower than the recent past. I think that's just the baseline assumption you should have. The question is how much lower, and it also depends on the industry that you're in and how your business is doing, and what the outlook for your market is, not just now but in the coming years. And so there's no rule of thumb I can give you and say, okay, well, if you were going to raise a Series A and Series A valuation was X in 2018 or 2019, it's now going to be 10% X or 20% X or 40%, less or whatever. It's really going to depend on the situation. And, but I would say valuations are going to come down. I think it's inevitable. You can't have the public stock market come down by, 30% and not have it impact the private markets. The availability of capital is the other thing. It's not just if a public company that does what I do is worth X and now is worth less than X, it's also the availability of capital. And so I think you're going to see over the course of 2020, capital that was coming into the VC ecosystem, particularly in mid and later stages in recent years, is going to dry up, right? So corporations that did a lot of VC investing, they're probably not going to be doing as much. Most of them are going to be doing less or no VC investing this year as they tend to their core business. Other kinds of groups that were active in the ecosystem may be less active because of what their asset base looks like. So I would temper expectations from the recent past. And I say that not to scare anybody, because I think if you have a great business and a great team and you have a great market opportunity in front of you, there's capital available. And now's a great time to build a company. And so you may be able to raise capital at a valuation that you're perfectly happy with, and maybe, higher than, what you raised last capital round at. But if your benchmark is the recent past, meaning the last 1, 2, 3 years, I would expect that in almost all cases, valuations will be lower. The other thing I would say is, I think you're going to see, if I were a company raising capital in 2020, the story of beggars can't be choosers is true. However, I would say if you're in the position of having optionality in terms of how you raise capital, in addition to valuation, I would strongly encourage founders to think about the quality of their capital partner as much as they do valuation. And what I mean is, behavior changes in times of stress, and good investors are good long-term capital partners and good advisors and helpers of your business through cycles that go up and cycles that go down. And there's also other folks who, when things get tough, they aren't as helpful, or they aren't as consistent or transparent about how they act. And so I think if I was a founder raising capital and I needed to raise capital in 2020, I would temper my valuation expectations at least somewhat. And I would strive to be as choosy as possible about my capital partner and think about how, okay, we're in a time of stress. Who do I want to have as an investor in my company for the next 5 to 10 years? And, an intellectual sparring partner to me as a founder, if I'm fortunate to have that choice, because times of stress reveal, people's intrinsic behavior sometimes a little bit more. We have one more question here. Should we try and touch on this one, Nicole, or should we try and wrap it? I'll let you
if you want to answer it quickly. I just want to be cognizant of time.
More frequencies to be considered. Yeah. So I think the question is, are VCs thinking about what if, COVID-19 coronavirus is not the situation that we're in is not a one-time event, but where there's waves, whether it be seasonal or based on epidemiological sort of waves of this virus propagating throughout the world in the next year or two. make a long story short, we're not epidemiologists, and so I have no better idea. You know, I read all the news and some academic research and all the stuff that many of the people on this call probably read. So, you know, I'm hopefully reasonably informed layman, but I'm no more informed than anybody else. And so we don't have a concrete view as to, is this going to be something that occurs in 3 or 4 waves over the next 18 months? Is this going to be something that we're dealing with acutely for a short period or a long period? We don't know. I would say we are giving consideration to the fact that it is entirely real possibility that, you know, the economic and societal and health constraints that we're facing right now, March 26, 2020, it's one possibility that they could persist for many months. It's another possibility that they could persist for a shorter time, but then be revisited in the fall or next year or what have you. So those are all considerations that we think that that's entirely possible. I don't think that it is fundamentally changing VC behavior based on thinking, okay, well, this is going to be a wave, you know, this is one of 3 or 4 waves that's going to occur over the next 18 months. People are thinking about that, but it's not, we're not changing our calculus and saying, okay, because of that, founders, we recommend that you do X with your operating plan or Y with your capital plan.
Yeah, I mean, I think the only thing to add there is, unless you're working on something that is specifically health related, you know, you're working on something that makes understanding whether you have antibodies very, very easily at home, something along those lines that is very directly related to this particular virus. I think otherwise the expectation, I mean, again, you know, a layperson's expectation is that hopefully this gets normalized eventually to a flu-like, seasonal flu-like situation where we have vaccine every year and we have a hospital system that is built to handle the surge. But I think the question that is more top of my mind is, you know, again, going back to the earlier topic, what types of behavior that we're currently experiencing will become more enduring, and which one of these will be more of a temporary experiment, and that people still prefer the quote unquote ways of doing things once this subsides a little bit.
Cool. Well, thanks everyone for joining. This was recorded, so you'll get the recording after this. But again, thanks for spending an hour 15 of your time with us over lunch. We really appreciate it. Hope you guys enjoyed it.
Thanks, everybody.
All right.
Be safe.
Thanks, everybody.
Take care.
Thank you.
Yep.